a hawkish surprise. In other words, right now we're anticipating a rate hike of 0.25% in September, maybe one other 0.25% or 0.5% total by the end of the year. That's not really all that hawkish right now, especially when you consider where the current Fed funds rates rest. He's really preaching a solid game of hawkishness, and he's not delivering that. Now, that could change, but it's not as hawkish as many people anticipated it might be, and that's why you saw gold recently, I believe, partially the reason the gold moved higher and silver moved higher, because it's against the basic principle that when you have war, geopolitical tension, that tends to be extremely bullish for gold because it ratchets up the uncertainty factor. For whatever reason, that diminished on this particular run.
Central bank monetary policy expectations are shifting rapidly as upcoming interest rate hikes appear far milder than initially feared. Current consensus points toward a 0.25 point increase in September, with cumulative tightening capped at 0.5% by year-end. This tempered approach continues to inject strong upward momentum into precious metals as broader geopolitical risks evolve. Gary Wagner, a seasoned market technician and precious metals analyst, contends that this divergence between hawkish rhetoric and actual policy execution fuels sustained demand. While earlier macroeconomic models pointed toward an ambitious $6,000 price target, updated technical forecasts project gold reaching a realistic high-side ceiling between $5,000 and $5,100 before the year concludes. After testing critical support bands, the asset is structured to challenge these key overhead resistance levels as monetary liquidity conditions shift. Now, we present the clips from Gary Wagner's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If you make a call and the market data doesn't support it short term, we continued to move lower, I had to modify that target. 6,000 was that. Right now, what I'm looking at is if I look at the all-time record highs, 5,500, 5,400 in that area, I think that 5,000 or 5,100 on the high side is what we could get out of this year, which of course is not the highest level we have seen. Gold traded to its all-time record high earlier this year. And so now we have clear-cut points of resistance after moving down from about 5,500 or so, and then hitting roughly, and this is basis futures, but there'll be, I think, about $10 apart December gold and spot. But we saw it actually break below 4,000. And when we look at some charts, I'll tell you why it was interesting to me in terms of the real bodies and what we call the wicks on a candlestick and the lows that came in. It was very telling that it could be really potential support, and that's what occurred. When I look at what happened 2011, 2012, which was the run up to then the all-time record high, and it moved above $1,900 per ounce for the first time in history. And what we saw was really a multi-year correction that took it to about 1,020, if I recall. It was February. It was reported that George Soros was accumulating heavily, and the market took off from about 1,000 and slowly moved up. What we saw during this correction is an incredible move, new record high, but at the same time, when it came down to about $4,000. And so to look at it, when you see this kind of run and see how aggressively it really maintained a price point. Let me move this just a little bit to get this out of the way. A price point, as you can see, where the wicks kind of flirted with, I've got it at 39.68, and it kind of matches up with these lows here. And so now we've got a much more clear path in terms of what areas to look for resistance, for support, only because now it's back trading in a range. It's been to this price point before. If it makes new lows, it tells us one thing, but we know on a technical basis where to plot it, because even though even the most staunch technicians acknowledge that it's fundamental events that move the market, but what's great about technical indicators is they give us good readings for entry and exit points, levels that could be support or resistance. And so the 4,000 that we saw recently, I mean, if we go back just to July, this really was a base. You can see how it traded with lower high, all the way down. You had a series of lower lows. And so what, excuse me, what I saw was a descending top and a flat bottom. It is one kind of the triangle patterns. And typically, when you get this kind of a pattern in a downtrend, more times than not, it'll break to the downside. In other words, it will break to the prevalent direction of the current trend, which was down. It did not. And when it broke above that, it did so really with fury. And I'm looking at weekly charts to kind of give you an idea and smooth that out. But yeah, we definitely hit a bottom. We hit a bottom that lasted in terms of time for about a month and a half. And then during 1 week, we really had this market move on Monday, 3rd day of August. And it hasn't looked back. Depending on where they got in, anywhere in this bottom, they're in great shape. In a futures trade, which is much more a whole different set of rules that you follow when you accumulate. I'll buy gold at a certain point and I let it sit. I'm not bothered by a $300-400 drawdown per ounce. It's not the world is ending. I have the physical gold. I'm not buckled in by time because you have it for as long as you want. When you're trading, you don't really take that kind of a risk-reward ratio. First of all, especially in futures, the big news is leverage. Leverage gives you maximum buying power. And I tell people that aren't familiar with how that relates in the business world is when you get a mortgage, if you put 20% down on a $500,000 house, when it moves up $100,000, although you had a down payment equivalent roughly in that area to that, at the same time, you've doubled the money that you put in for the down payment. So it's a leverage that has a potential for great reward, but obviously the potential for extended risk. One doesn't go without the other. Yeah. So as it came down, the key to me was you hit this record high. We did, it took quite a few people by surprise. I was one of them. I didn't think it would get that high. Then we had a really exaggerated low. And then we had these series, these red arrows of lower highs, lower low. And you saw something happening, especially on a weekly chart, in which you had all of the range of each week to really be right around and above 4,000. And that told me that there's a really strong possibility that we are looking at the correction having concluded. The red line here is the 200-day, 100-day, and then 21-day short term. They're all simple moving averages. So effectively, what we look for a couple of things. One, we want to see the relationship, for example, between the 100 in blue and the 200. You can see how they widen. They move farther apart. That is what you want to see in a bullish market. That also tells you when you have the longest term moving average at the lowest value, what that tells you is that it's in full bullish alignment. And obviously it ran out of that.
Weekly candlestick chart formations reveal significant structural shifts following extended market corrections. A technical formation defined by descending tops and a flat horizontal base typically resolves downward during an established trend. However, market momentum defied standard chart patterns by executing an aggressive breakout to the upside. Price action established a robust consolidation zone, where candlestick wicks continuously held above the key $4,000 support baseline for over a month. At the same time, the 21-day, 100-day, and 200-day simple moving averages widened substantially. Having the longest-term moving average positioned at the lowest value establishes complete bullish alignment, confirming that the corrective downturn completed its cycle. Now, let's get back to the interview.
The similarities in gold and silver in terms of price range, percentage gains and losses is, if you look at January 29th, that's when gold topped. You had a series of lower lows. But the fact that silver broke 100 effectively resulted in the largest percentage gain where silver outperformed gold. And during a rally, typically gold outperforms silver in terms of percentage gains. During a drawdown, silver can easily outperform gold. One is the liquidity and volume, the open interest, number of contracts. And silver is not traded with as many contracts as gold is. So you have a different liquidity. But in terms of the year, I was really, when we consider that at the beginning of the year, we saw silver move not only past 100, but 123, because its base and ceiling was at around, about 60 to 65 in terms of the records we witnessed prior to that. As you can see, there was this slow, methodical move up as we were trading through 2025. Take a small dip, and you get almost a parabolic move to the top.
Yeah.
And the top was roughly double of what we saw as a baseline for silver. Gold somewhat the same, but you get wider moves. I look at the ratio, but if I'm bullish on gold, typically I'm bullish on silver. So I said they tend to move in tandem.
Yeah.
The difference is the percent gains or percent drawdowns, which can be significantly larger on silver. And I think part of it has to do with the fact that in silver, there is less open interest, meaning there's less a buy to a sell equals one contract. That's open interest. And there's less open interest, less volume, let's say. And therefore, it will react more sensitive to the same fundamental events. Actually, what I've done for about the last, say, 10 months is I've gone heavily into accumulation for storage. I'm not going to touch it. And I tended to buy a lot of the metals at a more favorable price. I started buying, I remember at around 1,500. I bought it at 2,000, and I've still got that. So I was basically dollar cost averaging on the way up. As it came down, I'm dollar cost averaging the losses, but I'm not under the guise of the leverage. I've traded futures since 1990, let's say, so quite a few years. I made a lot of money. I've also taken some sizable hits in different markets, grains being one of them when I was on vacation and left a large position open. But for me, if you're going to trade it, you want to get short-term gains, and you're going to have that leverage in futures. Then it's much more sensitive. You would get stopped out in a modicum of areas in both gold and silver as it went down, because in a rougher way, let me blow this up. You see the series high, lower high, lower high. Lower high, and you see the base that formed in it, and it held to 5,600, even maybe 5,590, which was a very strong level that used to be major resistance for silver years ago, and now had become support. We haven't seen gold react in the same way, because the major resistance became around $2,000 after it traded between 1,800 and 1,900, flirted back and forth, and then it popped just above 1,900. And many people thought, okay, this is when it's going to go up to another century mark. It's 2,000, and that's when it got slammed. And roughly half. When we look at gold right now, it's about a third.
Yeah.
We went from 55 to 4,000, but look at the base it was building. I'll have to recenter that. But you can see the slow and methodical move, and then you see it accelerating. The correction was almost shallow as heck. And then it went up, but there weren't parabolic moves. But you have a number of periods where it's a green candle, which simply means that the closing price is above the opening price. You draw it in green. If the closing price is below, you draw it in red. And you had an abundance of green candles on the way up. On the way down, it sold off. I said exaggerated, really because of the low that came in down here. Went up, and then it just meandered slowly. And this was a very logical point to look at, because they tested, in essence, 4,400 for so many weeks. And effectively, every time the wick, meaning the differential between the real body and the low of the candle, held above 4,000. And it was for a fairly long period of time, where you don't see a series of time where it moves sideways. There's the liquidation and the fear of remaining long. In terms of, it's hard to pick a bottom as it's coming down in a fast and furious way.
Managing exposure in precious metals requires understanding the distinct operational differences between physical bullion accumulation and leveraged derivatives trading. Physical gold and silver allocations permit systematic dollar cost averaging across multi-month cycles, insulating investors from sudden drawdowns without the burden of strict time horizons or forced liquidation. Conversely, trading futures contracts introduces substantial leverage, mirroring a mortgage, where a modest down payment controls a much larger asset base. While this leverage multiplies buying power and profit potential during rallies, it exposes market participants to rapid stop-outs during sharp corrective pullbacks. Silver exhibits considerably wider percentage swings than gold due to lower overall contract volume, reduced open interest, and tighter liquidity. This structural dynamic allowed silver to double from its historical $60 to $65 base to reach $123 during historical rallies. Crucially, former major resistance levels around $5,590 to $5,600 have now transitioned into strong foundational support on the charts. Recognizing these structural mechanics allows disciplined traders to balance risk across volatile metal markets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.